Hello and welcome to the Power of Passive Investing webinar series. We're excited to have a very interesting guest today, Julie Anne Peterson. Julian is actually representing a mortgage industry, so it will be very exciting to hear her take on where the lending industry is taking us this year. But before that, we would like to welcome Julian and ask to share your brief bio, please, with us.
Great. Thank you so much for having me. It's been a challenging couple years. I live in the great state of California, said nobody. We don't do much lending in multifamily here in the state of California and actually up the West Coast. We spend a lot of time in the Southern Belt states, but we are a national brokerage firm out of Dallas. So a little bit about me. I got started when I was 14, actually. I was a bank teller in the banking business, and always had my eyes on real estate. I thought I'd become a an agent in my early 20s. I said to myself, I don't want to pay a landlord. I want to own my own asset. So by the time I was 22, I bought a property in Los Angeles for 250,000, and I was in the bicycle industry. And at the time, we saw the riots come, and my bicycle shops ended up being looted. So I had bought a house and I needed to get out of Los Angeles, and I found a job with the same company up in the Bay Area. So I called a friend and I said, "Hey, would you like to buy a house?" And he said, "Sure, all I have is $4,000." So I ended up giving him my home. He ended up paying for it over a 30-year period. He refinanced it. He did great on the property, but it allowed me to move into other assets. And, my company is called Dancing Investments because these investments are not straight line. They're not up. They're not always down. They dance. We're experiencing right now folks that got into these assets and multifamilies, particularly that got into um, the bridge lending on multifamily, and they're having a really hard time, and including myself. I'm a owner operator. I'm a limited and general partner on these assets. And if you put bridge on these deals, they are challenging. Nobody would have known that we would be seeing interest rates go from 0.5, you know, 0.5%, all the way up to over 5 plus the
Yeah.
spread. So now we're paying 9.5% on a deal that we underwrote at 4.
Yeah, that's true.
So, a lot of challenges in the market. Rents are going down or are steady, depending on the market, right?
Yeah.
And the expenses have gone up. And insurance, we've had hurricanes in different markets. We're now getting fires in California, and you know, people want to get paid more, so payroll has gone up. So a lot of the assets that were bought, as I mentioned, 20, 21, 22, are really struggling. We're doing a lot of modifications to these loans and really trying to juggle, how do we get the revenues up, decrease on those expenses, and keep the party full, So that's what we're experiencing, and, doing loans on these has been quite challenging.
Yeah, no, I hear you. So, since this is not the first day of the challenge and it's kind of been continuing for some time now, do you see banks becoming slightly more flexible when it comes to loan modifications? Like, are they uh, trying to work with the borrowers?
Yeah, I would say the existing folks that have bridge on, and they are doing a pretty good job, and that being they're at 90% or they're at 85%, and they're good operators. They are modifying. These lenders are modifying. They don't want to take these assets back. But as we start to see the new presidential election changes that are coming here in January, into the White House, there's a lot of concern, like where are we going with tariffs? Is that going to increase the inflation? Are we going to be, this past month we saw a big increase in jobs, which, we all thought we are going to see a lot more reduction in interest rates. But now I even read last week that we might even see the Fed funds go up. So there's a lot of, again, balls in the air. People don't really know what's going to happen. And I think it's going to take about another 18 months to level out. Where are we with our tariffs? Where are we with unemployment? Where are we at with the absorption of these new assets? We absorbed over 600,000 units across the nation in multifamily, and there are continuing to have another 400, over 400. So we're having 1 million units being delivered into multifamily in the Sun Belt in particular, and that is really having these operators struggle because they want to fill up their projects and they want to be able to get out of them on a sale potentially, and that's just it's very challenging. So again, for the absorption, listen, the demand is there for multifamily. We cannot see people jumping into new home sales. It's just the interest rates are so high that, everybody's staying or going into multifamily assets. So depending on the market, the Sun Belt is going to take another 18 months, maybe even up to 3 years in certain markets to absorb those units.
Julie, it's interesting you mentioned that the demand is there and we don't see the increase of home ownership. A lot of people are prefer renting now, and yet a lot of areas, geographic areas, I mean, are experiencing either steady rent or rent decreases. So how do the two and two align, more or less?
Yeah, I think it's all because of all of this the new inventory. So it's going to take these older buildings longer to stabilize. If you're
Yeah.
in the middle of a renovation, that's going to take longer. This whole idea of get rich quick, a lot of people jumped in. And that was another reason why we're seeing so much development and deliveries right now is so many of these groups tried to get in and buy these already existing assets and they couldn't. And they said, well, I'm not going to continue to show up and not close on these assets. I'm going to go build them.
Mm-hmm.
So Joe Schmo and Steve Smith went out and developed these. They weren't great. They had very little experience, and now
Mm-hmm.
they're running to get these delivered so it can get off their balance sheet. And I think, a lot of people are going back to finding a job instead of staying in commercial real estate. We've seen a huge decrease in the number of assets selling. We're down about 70, yeah, it depends on who you listen to, but 65 to 75% of sales on multifamily
Oh,
are
wow.
down. So, and so even as a lender ourselves, we're experiencing the same situation. So,
Wow, that's incredible. So, keeping in mind that a lot less apartment buildings are selling, um, would you say the environment is shifting from being a seller's market to becoming more of a buyer's market for
abs
multifamily?
absolutely. Where we were seeing a lot of hard money coming in on the EMD,
Mm-hmm.
the earnest money deposit, those were
Yeah.
going hard day one, and that's not happening now. You're getting through the whole due diligence process. Maybe you're going to be putting down a 1%. And then we're seeing a bunch of extensions because a lot of people have pulled away or have said, I'm on hold
Mm-hmm.
to invest in these deals. Quite frankly, it's the best time to be investing in multifamily because you can get quite a good deal. Now, I would tell you that these deals are Class A.
Okay,
Class A, institutional, great deals. You can also find deals on the smaller side, but these are not the ones that are being marketed. These are the mom and pop that have owned it in their family for 30 years. They're ready to get out. So
sure.
we're seeing that also as an option, where they're just ready to move out of
Class A,
multifamily.
sure, I'm sorry. Class A institutional level, again, are not for someone who is complete newbie. These are more for people
Correct.
that have been around the block and know what they're doing and can syndicate such
Sure. Absolutely. Yeah.
deals. Sure. And you've seen the discounts, like offered the assets offered at a discount?
Oh, absolutely. And the thing is just this week, interest rates had gone up 20 basis points. So a lot of people went back to the seller and said, I need a reduction in price. Uh, that was on Monday. We got a reduction of price. Today, Friday, the rates came down on the 10-year Treasury, 20 basis points. We saw 15 basis point change on Freddie, decrease. So
So tough.
are we going back to the seller and say, oh, let me go and change the price up? No. So, this last 2 or 3 weeks, it just has gone up and up and up. And that is based on the treasuries, and the treasuries are based on public sentiment. And as
Hmm.
we've gotten closer and closer to the new presidency, it continues to go up. And that's
Yeah,
uncertainty. That's based on uncertainty. That's not based on what the Federal Reserve is saying. This is based on what's happening in the marketplace. And the 10-year treasury, or the treasuries themselves, are based on the bond market. So a lot of us have seen the stock market doing very well, while the
yeah,
bond market is really struggling at this point. So
yeah. And given the fact that the new administration is coming in a
mhm,
matter of days, that will also impact the lending environment. Um,
absolutely.
and I mean, you've been in the industry for quite some time. So, from your experience, what do you think you potentially expect in terms of the lending environment? Like, where is it taking us?
Yeah, I think that we're still in for a difficult 2025. It was survived to 25. We held on to that.
Yep.
Like the gates of heaven are going to open on January 1st, 2025. And quite frankly, I was on the sidelines thinking, well, I'm not sure all of that is going to happen here. And the more I read, the more I listen, I'm bullish about that idea, where I think it's probably another 18 months or so where the folks that are, smaller investors, they're going to have some certainty. But I will tell you that I think you might have missed out on this 18 months. If we don't deploy capital in the next 18 months, it's going to be already the returns are going to be a little bit less, because let's face it, if the interest rates are lower, pricing is going to be a little higher. We are hearing that in the next 18 months that we're probably going to see some cap rate compression, which means values go up, but then you're going to be paying for a higher price for these. So the time is now to get into these deals. It's just finding the right fit.
For sure. And Julie, let's switch gears a little bit and talk
Mhm.
about your experience as a multifamily operator. Obviously, the environment is shifting, as you
Yeah.
said, from a lending perspective. What are you planning to do differently or doing already differently as an operator when you're underwriting deals, when you're making offers, and when you're planning ahead for the next
Yeah.
years?
So, well, we implemented a couple things on our properties. We've seen a lot of fraud, especially in the Houston area. So we have really pinpointed a property application whereby your applicants can be visibly looked at from start to finish, where they work, looking at the checks themselves.
Hmm.
And quite frankly, once we brought that in, the first application we got was fraud. So of course we're
Wow.
like, wow, this is huge. So we implemented that oversight. That's been great. It's based on the number of units that you have. It's like, less than $3 per unit, and it has caused us an enormous amount of savings of bringing in bad residents into our properties. So that was one thing that we saw.
Yeah, and question on that, and thanks for stopping. So you implemented some sort of tool that allows you to see everything about the potential tenant. And when you say
Correct.
fraud, people were given like fictitious jobs to you or fictitious names?
Correct. Or they were giving us the checks that were fake checks,
Oh
and
my
we
God.
could the software that this company uses, the company is called DocuVeris, and they have a different type of software that can, there's other companies out there that all have a certain level of investigation, but this software with DocuVeris can go even a little bit deeper and can really see if the check number is correct in some of uh, I don't know exactly how it works, but
Sure.
they can go a little bit further in depth investigation. So that's been
Okay.
huge. Yes, when I see how many applications go in and I see denied, you're like, darn it, we could have
Amazing.
had this thing full, but
Yeah,
I don't want my property full of people that I'm going to have to pay $650 to get them out.
right.
And, the evictions are costing a lot more. They're taking longer. So having that on the front lines has been a huge game changer for us.
Of course, yeah, that's incredible. One of the things that I remember developing when I was still on IT side was called KYC, Know Your Customer. So that's one of the
Yes,
things that's used to verify potential clients, whether they're tenants or whether they're applying for a job and whatnot, which is
sure.
amazing.
Absolutely. Absolutely.
Yeah,
So that was one of the things that we implemented. The other thing that we implemented, and it has paid off, is the insurance for all your residents. Um, we started doing that up front. You
hmm
will pay for rental insurance. And we had a fire, and it was determined that it was from it's being covered by the renter's insurance. So what
Oh,
would have
great.
cost us 150,000 to repair that that coverage is helping us. So we're
Amazing.
grateful for that. It was the first year that we put it in, and that's been great.
Amazing. So now it's a
Mhm.
requirement for all tenants to have their own tenant insurance.
Absolutely.
And do
Yep.
you review it to make sure that they have proper coverage?
Yes, we provide the service. So it's a fee share.
Uh-huh.
So they do all the application through us, and then we charge them through their rents.
Got it. Excellent. Very
Yeah,
nice.
that's been great.
Got it.
So yeah, we are trying to find every solution. I would tell you that our biggest interest is to keep the existing residents. So we have not raised the rents.
Mm-hmm.
We want to keep them. There are probably 20 out of our 134 unit building that have been there for 20 years or so. If they move out, we are going to have to do an extensive renovation on their property,
I
on their
see.
unit. So in an effort to, try and minimize any outlay of capital to fix those turnovers, we have decided to make this decision to not raise those rents on those 20 or 25 units that have been there for a long time. So that's been great. We continue to keep the residents that we have there. We're probably off about $300 a unit from what our pro forma was, but the goal here is to keep them in their units, and the goal is that and 90% occupied. So that's what we're working on, and our lender absolutely loves us. My property manager is also an owner in so we're vertically integrated, and
Mm-hmm.
she's been through 4 or 5 cycles, so she
Oh, wow.
knows exactly how to get around, some different options that maybe another property manager doesn't have that skill set.
Right, right.
That's
That's
been super helpful.
what market is that in?
This is in Houston, this one deal that I'm talking about. Yeah.
Got it. I see. Are you
Yeah.
continuing to search for more deals?
I am. Again, I'm a lender, so I'm helping my clients find properties. They've got 1031s, they need to move out of those, so I'm helping them find assets. And if I'm a sponsor as well, so I'm helping one of my clients to get into the deal. I'm helping find the sponsors. I'm very involved on so many levels to get these deals done for my clients that I can bring in capital with capital as a capital raiser. I've capital raised 10 million for deals. So yeah, I'm kind of a one-stop shop kind of deal.
Yeah, amazing. Yeah, you're definitely someone that other people would need to know. We will get to the point where we'll ask for your contact information because I'm sure folks who listen to this interview would want to reach out to you, Julie.
Right.
So, Julie, what would you say for the folks that are either getting into the commercial real estate or already in the
Mhm.
commercial and are thinking about their next purchase? What kind of advice would you give them knowing about the uncertainty that's ahead of us for the next couple of years?
Yeah, it's a great question. And I would say you need to know who you're in business with. As a limited partner, remember, you're sitting in the back of the plane. The general partners are the pilots. A limited partner is a member in the back of the bus, right?
Just, yeah,
So you're flying, you don't have a lot of you can get a snack here and there, but you're not making any decisions. So you want to know who those captains are. You want to vet them. You want to know what their past experience was. And let's face it, nobody knew what was going to happen the last 3 years. So to hold that against them is somewhat short-sighted because even the best operators got hit with that.
right,
But knowing how their strategy is to get through these moments, I think is really helpful. So getting to know these folks, um, finding out what returns they have used in the past. Have they been able to deliver that? And how are they looking at deals now? Are they being as aggressive? Are they looking at renovating all the units like we did over the last 3 or 4 years? So getting a sense of what their criteria is, what their business plan is, and does it marry into your business plan for your retirement, your deployment of capital. Because at the end of the day, this is all about, many of us, I should say, are looking for passive income.
right.
And in markets like me, where in California, we don't buy for passive income. We buy for the appreciation. So if that's something that you're looking for in an appreciation type play, then go to those markets and look for those good operators. But most of us are looking for passive investing. And I would also tell you that it's no longer the get rich quick. It's no longer we're going to turn these like a fix and flip model in the single family. It's not going to be 18 months to 3 years. You're going to need to be in these and be thinking about, okay, what's this timeline for a return of my capital? It's going to be at least 5 years, maybe even 7. And in some cases, if you're already in a deal, it could be a 10-year deal, even though you signed up for 5 to get through the next 3 or 4 years with a lender that wants to stay with you. It's going to take time to get rolling um, and get
For
your
sure.
money back.
Makes sense. And that's from a standpoint of a passive investors. And for those that
Yeah.
are getting into the game as the active
Yeah.
investors or GPs, what kind of advice would you give them?
Yeah. So again, your biggest partner in this is a lender. They can make or break you. They can give you the wrong lending vehicle. Again, maybe Bridge looking back, was that the best? Probably not, but it brought in a lot of opportunities for people. But having a lender like us over at Old Capital, we are not only your lender, we are a partner. We can help you find deals. We've got excellent relationships with brokers. Again, we can help you find capital. You want somebody that's on your team. right? You're looking for
Sure.
these partners. You're wanting to find sponsors because from the lending standpoint, if you are brand new, you're going to need somebody with net worth, with liquidity, with experience. Okay, so those three things, if you can't answer, I have enough money in the bank, you're going to need to find a sponsor. So getting
Sure.
out your network and asking, hey, I'm looking at $10 million deals. What can you bring to my deal? And would you be open to signing on a loan where? What part of the United States? Because once you find a sponsor and they say, hey, I want to be in Cincinnati, then go to Cincinnati and start to find deals in Cincinnati. This
Exactly.
idea of I can use other people's money, or this idea of, oh, if I find a good deal, the money will come. That's not the case. So not only you're looking for sponsors, lenders, you're also looking for capital, the equity in the deal. You really do need to be looking for investors early on. Yeah.
Amazing. Yeah, absolutely agree. And amazing
Mhm.
advice. Thank you for that, Julie. So, on that note, let's wrap up the interview with our two last personal questions. The first and foremost, how can our audience reach out to you? Where can they find you? And what's the easiest and best way for you to to connect with you?
Yes, great. Well, I'm available on all social media, LinkedIn, Facebook,
TikTok.
Instagram. I'm under Julie Anne Peterson, ANNE Peterson. Make sure when you want to connect with me, let me know where you heard of me, and then I can make the connection. I don't like to have somebody just randomly. I won't connect with you in that way if I don't know where you came from. Also, I run every Tuesday night, I do a Zoom at 8. It's 8 o'clock p.m. Eastern, and you can find your next partner there. I'm obviously there, and you potentially capital raise there, but we spend an hour and a half with industry experts in a live conversation, and you can get in the rooms with these folks and ask questions. And people have built their business on Zoom at 8. So you can register just www.zoomat8.com,
Very
and
nice.
we'll send you the link and come join us every Tuesday night.
Excellent. Thank you for sharing that and for sharing the link. I think that's very beneficial. And I can personally add that I've attended a few of these webinars a few years ago and I found them very valuable. And I know Julie is a big connector, so it's always great
Mhm.
to get to know Julie and attend some of the sessions and learn more about real estate, lending, and hear other presenters speak for sure. So
Yeah,
thank you for
yeah.
sharing that, Julie. And the last personal question that we always ask is, how do you like to give back?
Boy, I love educating people, and that's why I started the Zoom at 8 because my passion is I learned on my own. I didn't have a way, I didn't have a method. I didn't spend 30,000 to be educated. I did it on my own. And so I want to give back, and that's what Zoom at 8 is. It gives back. It's free. It gives you a place to meet people, to orient yourself with this industry and with these industry experts. So that's been my vehicle to giving back.
I love it. I love it.
Yeah,
And I know you put a lot of efforts into this and treat it like your
yeah,
baby.
yeah,
In
yeah,
addition to your other babies, of course.
yeah,
Yes,
yeah.
excellent.
Thank
Julie, thank you so much. It's been an amazing interview. We're very grateful, and I hope our audience reaches out to you because you definitely have a ton of experience and is a great resource and treat others as a partner when you work with them. So really
Yeah.
appreciate it.
Thank
Thank
you so
you.
much for the opportunity.
Thank you.